You've probably heard the saying, debt is one of the biggest burdens in life. Most people, and probably you too, believe that having debt is like financial slavery. And in many ways, that's true. When you are overwhelmed by debt, it can feel like there's no way out. While you're struggling to pay it off, interest keeps accumulating, making the problem even bigger. Picture this. Student loans, mortgages, credit card bills, they all seem impossible to pay off. But what if I told you that these debts could make you rich? The idea that debt could be used to generate wealth might sound like a scam, but in reality, it's one of the most powerful financial tools available. The main difference between the wealthy and the average person isn't just in the amount of money they have, it's in how they use debt to their advantage. In this video, I'll show you 16 different ways billionaires leverage debt to build immense wealth, minimize taxes, and create multiple streams of income. I can already tell you now that number 4 and number 12 on this list are the ways that made 80% of billionaires rich. But before we start, I need to warn you about one thing. Using debt to make money is still a risky move, so be careful when you try these tricks on the list. But now let's dive in. Number 1, using debt to generate passive income. One of the most effective ways to use debt is to invest in assets that generate passive income. Wealthy individuals don't just borrow money to buy liabilities, they use it to purchase income-generating investments. For example, an investor takes out a loan to buy rental properties. If the rental income covers the mortgage payments and operating costs while still providing a profit, the investor is essentially making money using the bank's capital. Over time, property values increase, rents rise, and the investor's equity grows, all while the tenants are paying off the debt. Another way billionaires use debt for passive income is by investing in dividend stocks using borrowed money. By purchasing stable dividend-paying stocks on margin, investors can use the income generated from dividends to cover the interest payments on the loan while still profiting from stock appreciation. Some billionaires even use debt to finance businesses that operate independently of their involvement. Take franchises, for example. An investor can take out a business loan, open a chain of successful franchises, and let the hired management team run the day-to-day operations while they collect profits. The key here is that borrowed money is being used to buy assets that generate cash flow rather than liabilities that drain finances. Number 2, leveraging low-interest loans to invest. Billionaires understand that debt can be incredibly cheap when interest rates are low. Instead of tying up their own capital, they borrow at low rates and invest in opportunities that yield much higher returns. For example, if an investor can borrow money at 2% and invest in a business or stock market portfolio that generates an 8 to 10% return, they effectively earn the difference without risking their own money. This strategy is used frequently in the stock market through margin investing, where investors borrow money to amplify their potential gains. Consider Elon Musk, who has repeatedly used low-interest loans to finance Tesla's expansion, rather than using the company's cash reserves. By keeping capital available for strategic moves and investing borrowed funds into high-return projects, companies can maximize growth potential. Another example is in the real estate industry, where developers take advantage of low-interest loans to construct new properties. Instead of funding everything with their own money, they borrow large sums at favorable rates and ensure the rental income or sales proceeds far exceed the loan costs. When done wisely, leveraging cheap debt can significantly boost investment returns without excessive risk. Number 3, using other people's money, OPM. A key principle of wealth building is using other people's money, OPM. This is how businesses expand, how real estate empires are built, and how billionaires grow their fortunes. For instance, an entrepreneur might secure funding from investors, banks, or even customers before launching a product or service. This minimizes risk while maximizing growth potential. Many of the world's top businesses started with borrowed capital rather than the founder's personal savings. Consider how startups secure venture capital. Instead of using their personal funds, founders pitch their ideas to investors who provide capital in exchange for equity. This allows them to build billion-dollar companies with minimal financial risk. Real estate investors also use OPM by forming partnerships where investors provide funding and the operator manages the deal. The profits are then split among the parties, allowing investors to expand without using their own capital. Before moving on to the fourth method, I have a bonus method for you that you can start using right now. In the description of this video, you'll find access to a completely free school community with a free course that I made and a free one-on-one call from me and my team of experts to help you make money online. It literally takes 1 minute, so run and sign up for free. Number 4, debt for tax advantages. Debt can be a powerful tool for minimizing taxes. Interest payments on loans are often tax deductible, which means that billionaires can reduce their taxable income while still using borrowed money to grow their wealth. A classic example is real estate investing. Property owners can deduct mortgage interest, depreciation, and other expenses, often resulting in little to no taxable income, despite generating cash flow. This strategy has been used by many high net worth individuals to build tax-efficient wealth. Or think about business owners who finance operations with loans. By using debt instead of equity financing, they can deduct interest expenses while still retaining full ownership of their company. Even corporate giants like Amazon and Tesla use debt strategically to reduce taxable profits while fueling growth. Number 5, buying back stocks with borrowed money. Large corporations often use debt to buy back their own stock. This reduces the number of shares on the market, increasing earnings per share and driving up stock prices. Take Apple, for instance. Despite holding billions in cash reserves, Apple has frequently issued bonds to repurchase shares, allowing the company to increase shareholder value without depleting its cash reserves. By borrowing at low interest rates and reducing outstanding shares, companies make existing shares more valuable, benefiting shareholders and executives with stock-based compensation. Number 6, starting businesses with minimal personal risk. Rather than risking their own capital, many successful entrepreneurs fund their ventures using loans, venture capital, or lines of credit. This allows them to scale their businesses while maintaining financial flexibility. Take Jeff Bezos as an example. When he started Amazon, he borrowed money from his parents to fund the company's early operations. That initial investment grew into one of the most valuable companies in the world. Another example is startup founders who use venture debt, a type of financing that allows them to borrow against the future value of their business. This method helps preserve equity while still allowing for rapid growth. Many Silicon Valley tech companies use this strategy to fund expansion without diluting ownership. Number 7, real estate refinancing. Wealthy investors don't just buy real estate, they strategically refinance it to pull out cash and reinvest in other properties. This allows them to continue growing their portfolios without ever selling their assets. Through refinancing, they can access tax-free cash while allowing rental income to cover the new loan payments, effectively using debt to expand their holdings indefinitely. For example, an investor purchases a property, lets it appreciate in value, and then refinances it at a higher valuation. The new loan provides cash that can be used to purchase additional properties, all while the original tenants continue covering the mortgage payments. This cycle can be repeated multiple times to build an extensive real estate empire with minimal personal capital investment. Number 8, stock market margin investing. High net worth individuals and hedge funds often use margin investing to leverage their capital. This means borrowing money from brokers to buy stocks, increasing their exposure to potential gains. While risky, this strategy allows investors to significantly amplify their profits when the market is rising. For instance, an investor with $100,000 in cash can borrow another $100,000 on margin to buy $200,000 worth of stocks. If the market rises by 10%, the investor now has $220,000, doubling the gain they would have had without margin. However, margin investing also comes with risks. If the market declines, investors must repay the borrowed money even if their stocks lose value. This is why experienced investors use stop-loss strategies and other risk management techniques when engaging in margin trading. Number 9, collateralized loans. Instead of selling stocks and paying capital gains taxes, billionaires use their assets as collateral to secure loans. This allows them to access large sums of money while keeping their investments intact and growing. For example, a billionaire might use a stock portfolio worth $10 million as collateral to borrow $5 million. They can then use this money for new investments, real estate, or business expansion without triggering a taxable event. Many banks offer ultra-wealthy clients favorable loan terms for collateralized loans because they are considered low risk. By leveraging their existing assets, billionaires can continue to grow their wealth without liquidating their holdings. Number 10. Private equity and leveraged buyouts. Private equity firms specialize in acquiring companies using borrowed money, a strategy that allows them to control vast enterprises with minimal personal investment. The key mechanism here is the leveraged buyout, LBO, where investors purchase a company primarily using debt. Instead of risking their own funds, they leverage the company's own revenue to pay back the borrowed money over time. This approach enables them to acquire businesses, restructure operations, cut costs, and later sell the company for a profit, repaying the initial loans in the process. A great example is the takeover of RJR Nabisco in the late 1980s by the private equity firm KKR, one of the most famous LBOs in history. KKR financed most of the $25 billion deal with borrowed money, restructured the company, and later profited from selling assets. Today, firms like Blackstone, Apollo Global Management, and the Carlyle Group use LBOs to acquire and expand businesses without tying up too much of their own capital. Number 11. Short selling and hedging. Billionaires and hedge fund managers often profit even in declining markets by short selling stocks. Short selling is a strategy where investors borrow shares of a stock they believe will decline in value, sell them at the current market price, and later buy them back at a lower price to return to the lender, pocketing the difference as profit. For instance, George Soros is famous for his 1992 short bet against the British pound. He borrowed and sold billions of pounds, correctly predicting that the currency was overvalued. When the pound crashed, he repurchased it at a lower price, making over $1 billion in profit in a single day. This showcases how sophisticated investors can use borrowed funds to generate massive returns by betting against economic weaknesses. Number 12. Currency trading using debt. The foreign exchange, Forex market, is one of the largest financial markets in the world, and billionaires utilize debt in the form of leverage to amplify their returns. Leverage allows traders to control a large position with a relatively small amount of invested capital, magnifying both potential profits and risks. For example, a trader might control $1 million worth of currency with just $10,000 in their account using 100-to-1 leverage. If the currency moves favorably by even a small percentage, the returns can be substantial. However, leverage also increases risk, as a small unfavorable movement could wipe out the trader's initial investment. Hedge funds and institutional investors use sophisticated risk management strategies to ensure profitability in Forex trading. Number 13. Acquiring companies with leverage. Billionaires and corporations use debt to finance acquisitions and mergers, allowing them to expand their market share without depleting their cash reserves. This strategy enables companies to grow at a rapid pace while using borrowed capital to fund takeovers. One example is Elon Musk's acquisition of Twitter, now X, in 2022. Instead of paying the entire $44 billion purchase price out of pocket, he secured financing from banks and investors. By leveraging his existing assets and securing loans, Musk was able to acquire Twitter while preserving liquidity for his other ventures. Large corporations frequently use similar strategies to acquire competitors, expand operations, and increase market dominance. Number 14. Financing luxurious assets. Contrary to popular belief, even billionaires do not always purchase luxury assets like mansions, yachts, and private jets in cash. Instead, they often use debt to finance these purchases while investing their capital elsewhere for higher returns. For example, if a billionaire has $50 million in cash, they might take out a low-interest mortgage to buy a luxury estate instead of paying for it outright. By doing so, they can invest their cash in stocks, private equity, or real estate developments that yield higher returns than the interest on the loan. This way, they acquire luxury assets while continuing to grow their wealth. The same principle applies to private jets and super yachts, where financing allows billionaires to optimize their investment strategies. Number 15. Passing wealth through trusts and loans. Wealthy families use trusts and intrafamily loans to pass on wealth while minimizing taxes. Trust structures allow billionaires to legally transfer assets to their heirs without triggering large tax liabilities. For example, the Walton family, heirs to the Walmart fortune, strategically uses family trusts and loans to transfer wealth while avoiding excessive estate taxes. Billionaires often lend money to family members or trusts at low interest rates, allowing assets to grow tax-free. These strategies ensure that wealth remains within the family for generations while keeping tax burdens to a minimum. Number 16. Venture capital funding. Many billionaires build their wealth by investing in startups through venture capital, where they provide funding in exchange for equity in high-potential businesses. This allows startup founders to scale their companies quickly without giving up full control. A prime example is Jeff Bezos, who invested $250,000 in Google in its early days. That investment grew to be worth billions as Google became a tech giant. Similarly, venture capital firms like Sequoia Capital and Andreessen Horowitz use leveraged funds to invest in emerging tech companies, reaping enormous rewards when these startups go public or get acquired. By using debt and investor capital, billionaires can fund multiple startups simultaneously, ensuring that even if some fail, the successful ones generate astronomical returns, further expanding their wealth. I want to remind you that if you want to make money online, you can get help from us for free by clicking the link in the description. As I said before in this video, there you will find access to a completely free school community with a free course that I made and a free one-on-one call from me and my team of experts to help you earn more and finally change your life for the better. Now that you have understood that debt is not that bad, use it correctly, as the billionaires use it, and start creating immense wealth. Thanks for staying here. Please like and subscribe if you've appreciated this video, and I'll see you soon.